What if we told you the biggest housing bubble in the modern world isn't in the United States, still haunted by the ghost of 2008? It's not in the UK, with its centuries-old legacy of property obsession. The epicenter of the most extreme, mind-boggling property prices on the planet might just be a country known for its beaches, its koalas, and its seemingly laid-back attitude: Australia. For decades, the Aussie dream has been built on a quarter-acre block. But that dream has morphed into a financial fever dream. Prices have skyrocketed to such insane levels that the average home in Sydney now costs over 13 times the average annual income. To put that in perspective, at the peak of the US housing bubble in 2006, the ratio was about 7 to 1. We're dealing with a completely different beast. So, is Australia's housing bubble truly worse than what we saw in the US and the UK? And if the bubble is so big, why hasn't it popped? The story of how Australia got here is a tale of tax policy, fear, immigration, and a global addiction to cheap debt. This isn't just an Australian story. It's a warning sign for housing markets in Canada, the UK, and the world. Welcome to Money Stories. The story begins not in 2020 or even 2008, but much further back. To understand the Australian housing market, you have to understand its sacred cow, a tax policy called negative gearing. Introduced decades ago, it's a system that allows property investors to deduct any losses they make on a rental property, like the mortgage interest being higher than the rental income, from their overall taxable income. Essentially, the government subsidizes your investment loss, betting that the long-term capital gains from the property rising in value will make it all worthwhile. For years, this was a niche strategy, but in the late 1990s and early 2000s, it collided with another powerful force: a massive reduction in capital gains tax. Suddenly, the equation became incredibly attractive. Borrow money to buy a property, use the tax system to help cover the shortfall while you wait, and then sell it for a massive, lightly taxed profit. It was a recipe for a speculative investment boom dressed up as a housing policy. This coincided with a period of economic prosperity in Australia, famously avoided the worst of the 2008 global financial crisis, thanks to a mining boom fueled by China's insatiable appetite for resources. While Americans and Brits were facing foreclosures and crashing prices, Australians saw a brief pause, then a continued climb. This created a powerful psychological narrative: Australian property prices only go up. It's a can't-lose investment. This belief became self-fulfilling. Now let's pause and compare this to the US. The American bubble was built on fundamentally different and, in many ways, riskier foundations. It was a story of predatory lending, ninja loans, no income, no job, no assets, mortgage brokers handing out loans like candy to people who could never hope to repay them. These toxic loans were then bundled into complex financial products, given AAA ratings, and sold around the world. The entire system was built on a house of cards where the underlying asset, the homeowner's ability to pay, was completely fictional. When adjustable rates reset and people couldn't pay, the whole structure collapsed catastrophically. Australia's bubble is different. It's not primarily about subprime lending to disadvantaged homeowners. Aussie banks are notoriously strict with lending standards compared to pre-2008 US banks. The problem isn't who they're lending to, but how much they're lending. The bubble is fueled by massive mortgages given to middle and upper-class investors and owner-occupiers, all convinced of the infallibility of the market and turbocharged by those generous tax concessions. It's a bubble of privilege and policy, not predation. This is a key reason why it hasn't popped yet. The financial system itself isn't riddled with the same immediate, explosive toxicity. The pressure is building more slowly, but on a much larger foundation of debt. And then came the 2020s. Just as the market was showing signs of cooling, the pandemic hit, and governments around the world, including Australia, the UK, Canada, and the US, responded with massive economic stimulus. Interest rates were slashed to historic lows, literally touching zero. Quantitative easing flooded the economy with cheap money. For existing homeowners, this was a windfall. Mortgage repayments plummeted. For anyone looking to get in, it was a siren's call. Borrowing $1 million suddenly seemed manageable with rates at 2%. A fierce FOMO, fear of missing out, ignited a buying frenzy unlike anything seen before. In Australia, prices went parabolic. The same story played out in the affluent pockets of the US, across Canada's major cities, and in the UK. But Australia, with its existing policy setting and cultural obsession, took it to the extreme. The government even introduced a first home buyer grant that, while well-intentioned, ultimately just added more fuel to the fire by putting more eager buyers with cash in their hands into a market with limited supply, effectively bidding prices up even further. This leads us to the million-dollar question. If it's a bubble, why hasn't it burst? The first reason is supply. Australia's major cities are some of the most densely populated in the world, and restrictive zoning laws and NIMBYism have severely limited the construction of new housing, especially medium-density homes near city centers. Demand, on the other hand, has been supercharged by record levels of immigration, all needing a place to live. This fundamental imbalance imbalance of people versus properties creates a floor under prices. The second reason is that powerful cultural belief, the religion of real estate. In Australia, and similarly in Canada, property is seen as the single best and safest path to wealth. This isn't just about shelter, it's a national identity. This emotional, cultural driver makes people hold on far longer than pure economics might suggest. They'll sacrifice everything else, avocados, vacations, you name it, to keep that mortgage. This creates a market with incredible inertia, but the music is slowing down. The same central banks that flooded the world with cheap money are now frantically trying to fight inflation by raising interest rates at the fastest pace in a generation. And this is where the pressure point is. Those million-dollar mortgages that were manageable at 2% become backbreaking at 6% or 7%. We're already seeing a sharp cooling in prices, but a cool down isn't a crash. For a crash to happen on the scale of the US in 2008, you need forced sellers. So far, unemployment remains low, and people are cutting every other expense to keep their home. The real test will come if the economy tips into a significant recession and people lose their jobs. That's when the dam could break. And the scale of the debt is so enormous that the ripple effects would be global. So, is it worse? In terms of pure price-to-income metrics, absolutely. The average Australian is carrying more mortgage debt relative to their pay than an American did at the 2006 peak. The system is more stable in that it's not built on fraudulent loan, but that stability might be its greatest weakness. It's allowed the problem to grow bigger and bigger, like a slow-moving avalanche building map. A crash in Australia wouldn't start with poor subprime borrowers. It would start with over-leveraged, middle-class investors who own multiple properties and can no longer service the debt. The contagion would spread through the entire banking system. For viewers in the UK and Canada, this story should feel eerily familiar. You have your own versions of this crisis, driven by similar forces of low supply, high immigration, and a cultural love affair with property. Canada's bubble, particularly in Toronto and Vancouver, is a close second to Australia's in its extremity. The UK, especially London, has been a global money haven for years, pushing prices into the stratosphere. The story of Australia is a cautionary tale of what happens when you mix speculative tax policy with a cultural obsession and then douse it in historically cheap debt. It's a warning that a bubble doesn't have to be built on fraud to be devastating. It can be built on perfectly legal incentives and widely held beliefs. The question is no longer if the dynamics are unsustainable, but what happens when a generation priced out of the market finally says enough, and when the economic reality of higher rates finally overwhelms the deep-seated belief that a house is a one-way bet. The final chapter of Australia's money story hasn't been written yet, but the plot is certainly building towards a dramatic climax.